Alice sent me an email regarding a position she's considering on SLV. And she asked the question that, Mike, I'm considering purchasing a 2023-26 strike call SLV. Can you show me the probability of success on the position? And then she also had mentioned, can I also consider selling weekly calls against it? And this is effectively the position she sent, talking about that 2023 January 26 call on SLV, which is priced around $350, $360. And then selling a weekly June 25 call. The stock was around $24.20 early this morning. It dropped down to $23.88. So $24.50 might be a little bit more because this was only trading for 12 cents. And I said in my answer, I just don't think, in the answer via email, that I just don't think this is enough premium, even though it's only 7 days out, to really get anything. You might want to go 14 days out, maybe 20 days out, because you're looking at a long leap that's 581 days out in time. Now let's go to the profit and loss chart first from the portfolio tool. And let's stretch this out a little bit here. It's showing the position here. And again, the max risk is 446, which occurs if SLV does fall down in price. That's where we talked about with the lie of leverage there as well. First steps first. Let's clear this out, and let's talk about just the long call. Alice's basic question, first question, I should say, not basic, but Alice's question is, what is the probability of success on this position? Okay. When talking about buying a call or buying a put option, in this case, we're talking about buying a leap call 581 days out in time. Has a lot of time value in it for the 580 days, and it is out of the money. We're about 2 points or 8% out of the money with this long call. Now, when we talk about probability, in the case of something along the lines of a bull put credit spread, or the probability of getting assigned on a covered call position, or I have an out of the money bull put spread, an SLV here at 23.88, maybe I'm selling the 21 and buying the 20, and I know that there's a theoretical probability that the stock will remain above this strike price at expiration. Both puts will expire worthless, and I will keep the net credit. If I'm selling an in-the-money covered call, maybe we sold the 22 call here, buying stock at 23.88, maybe got $2.20 a premium. I know the probability the stock's going to stay above that short call strike price. I'll get assigned and make the full profit for a covered call position. That concept of probability doesn't really relate to buying calls, especially leap calls. And what I mean by that, let's go now to the option research tool. And if we look at this option research tool, we see that the theoretical probability above is 42.6%. So there's only a 42.6% chance, based on historical trading, that SLV is going to be above 26 on January 2023 expiration, 581 days away. That's not as useful as evaluating the probability in a spread or a covered call, whether you want to stay out of the money or you want to stay in the money in that case. But you don't want to know that anyway. And yes, it relates a little bit to delta. The delta is about 0.52 here. So they're close, but they're just not the same. And probably the reason why is because it's such a long term, 581 days, that the probability that's calculated there is taking into account that extra length of time. What do I mean by you don't really care about this probability above? Because if the stock's at 26.20 come expiration, and you hold it that long, you're losing 100%. If you held this to 581 days, didn't sell anything against it, Alice, and the stock, okay, did go above 26, was at 26.10, you get 10, okay, you didn't lose all of it. You're only getting 10 cents back of intrinsic value. You've lost $350 of the 360 cost basis in this case. What you're maybe more considering along those lines is what's the probability that the stock's going to be near 30. in 581 days if you're talking about that probability, which also isn't that useful. Why 29.60? Because that's your break even. You bought a 26 call and you paid 360. Well, you need the stock to be trading at 29.60 at expiration to break even if you hold it that long. So let's go to the option chain. And let's go to our 581 days out. And we got to go to the medium chain for calls only. And the 30 strike, because remember my break even is 29.60, we have a probability above here of only 32%. But again, this is not how a call buyer would even use probability in these cases. Even though, yes, that's my break even and I'm 581 days away, what a call buyer knows is with that delta of 0.52, if the markets start to recover next week, if in the next few days from now, silver wheaton moves up to 24.88, goes up $1, your option is going to gain about 53 cents. Because the delta is at 52.53, which means that translates roughly into a 14-15% return on the 360 investment. Was what I said in my email earlier, Alice. So the probability of success on a long call is based on the likelihood that the stock is going to go up in the direction that you want in a relatively short period of time. And of course, we can check that out on these screens as well. What would happen if, let's say by next Friday, we get up to 24.90? And we got to scroll way back here because this is looking at the halfway point, which is out to March of 2022. And so we're going to go just to next week, June 25th. And so we'd expect to see a gain theoretically of $44 on this position. Okay, maybe not as much as I had put in because of the delta, but that's okay. So we'd expect to see a gain based on the pricing models of about $44, which again is going to be around 12-13%. You're looking for more. So of course, if in a month from now, SLV, the metals markets take off a little bit more, as hopefully you're expecting, and the stock, let's say, it goes up to 25.50, well, you're going to be at a $78 profit on this position, which is now getting close to that 20-25%. So what you're asking is more along the lines of analyzing a stock and not the option in the case of call buying and put buying for speculation that the market's going to move one direction or the other, Alice. That's what you're really looking for in this case. Now, going over that probability and why it's not used by long-term leap buyers in the same case that we would use it for a covered call or a credit spread. What was the rest of your question? We're considering buying a 26 call at a price of 360. Now you ask, can I sell weekly calls against it? And you can, of course, but just as in the discussion we had of 2 weeks ago, I think, Alice, or 3 weeks ago, we talked about the calendar spread structure. This is not the right structure that I would use in this case for a calendar spread, or what some people refer to as a poor man's covered call. Now, let's just leave this at 7 cents. So right now, 1 week out, the 25 call, maybe the 24.50 would be back up to 10 or 11 cents. You're only getting 7 cents here. You've got an upper break even of 26.35 and a lower break even of 23.95. You've lowered the cost basis just to 3.53. This is why I was saying you might want to go out 2 or 3 weeks to get a better premium. Yes, you have 581 days, and we can say, well, if for every 7 days I get 7 cents, wouldn't that pay for this over 581 days? Perhaps. But again, you're looking more at the effect of the position in the profit and loss chart. Now you have a debit of 353, but it shows you here the max risk is 451. Where's that extra dollar coming from? Because in this structure, you bought a 26 strike call. It gives you the right to buy shares of stock potentially at 26, but you're selling a 25 strike call, which means you have an obligation to deliver shares of stock you don't own at $25 if the stock moves above that strike. This is essentially a bear call credit spread, but it's done as a calendar format. What that means is you have to cover the additional dollar here in margin requirement because if the stock's at 25.50, you're obligated to deliver shares of stock at 25, and your right to buy at 26 has not kicked in. So anywhere between here, you've got a potential for a margin loss that you have to cover. So your broker would require you to have $100 on hold in the account per contract to cover this obligation, because the call you're selling is lower than the call that you're buying. It's a structure similar to a bear call, but you went into a calendar format. Doesn't change the obligations of the options at all. If I wanted to simulate a covered call trade using leverage, I wouldn't be buying the out of the money position far out and selling a lower strike call shorter term. We'd probably change this. Okay, now you said go out 1 month, fine. We'll go out to the next standard expiration, July 16th, and we'll look at the 25 call, which is at 36 cents, 1/10 of the price in that case. All right, you still see we have the 10th profit and loss chart on the position. Upper and lower break evens are a little bit wider now, 23.51 until you hit break even. That means if the stock's trading below 23.51, next month at July expiration, you're going to start losing money on the position. The long call would be worth lower than 323.50. And of course, you still have to put that dollar obligation up on the trade. Investors who simulate a covered call trade using the leap calendar position wouldn't likely be buying the 26 call, the higher strike. They're going to buy lower with possibly a higher delta. And if I wanted to go out 581 days again, we're going to be looking at maybe the 23 or the 22 call. Is it more expensive? Absolutely. It's almost a third of the price more. Now we're at $4.95 instead of $3.60, an extra $1.30 more. Almost, a little bit more than a third. But see here, we get into a structure where we just have one break even, and we don't get into a second break even unless the SLV really takes off. But again, even there, you see it's flattening out. So it'd really have to go up to 30 or 40. By that time, you're already rolling this 25 call. Because I have the right now to buy it at 22 at a lower strike price, and I still have the obligation to sell it at 25, I'm completely covered. I don't have to put up any margin requirement to get into this position, Alice, in that case. So the risk is just the net debit that I paid to get into the position. Now, is this to say your 26 call is wrong? I'm not saying that. I can't give any direct advice on what call you should buy or should not do. I'm saying that as a general calendar structure, if you're looking to mimic a covered call to have the right to buy shares of stock at a lower price and sell at a higher strike, this is the structure that you would use. You'd buy the stock at 22. I'm sorry, you'd buy the call at 22 and sell the July 25 call. You wouldn't be doing that, buying the 26 that's out of the money and selling a lower strike call, because then you have to cover the extra obligation. Here, the obligation is just the net debit that you paid to get into the position. Yes, I changed it to the 22 call outs to show you what the more preferred structure is for this type of what's called calendar call setup. Our investors that do the other way, but again, you saw the risks with that. Okay, so if the stock starts to go above the strike price, here you're covered. In the other case, you're not until it goes above 26. In that other structure that you created, you also saw two ways to lose. You had a lower break even around 23.51 and an upper break even around 26.20 or something along those lines. And so the potential max return here is about 22.5% on this structure. Yes, it was higher with the other structure, but remember, here's the dilemma. The return you're considering, Alice, is if and only if the stock is trading right at $25 at July expiration. Yes, this is July 16th. That one chance is the 22.5% return. If the stock's trading down here, you're not making as much. You're making a third of the expected profit. If it moves up here, you're making half of the expected profit. That's the way the calendar spreads work. Now, in the case of your initial structure, let's go back to your initial structure one more time. Well, prices changed, so it's, I had it at 360. We'll use it about 355. That's fine. Let's get these numbers straight. 355 on the ask, and let's just put this at 36 cents. All right. So this is your structure that you were planning. The debit was 319, but the max risk is 417, very similar to the other position. A little bit lower. The max return is 25.9%, if and only if the stock is trading right at 25. Okay. And then as you go down, you start to see you're at a fourth, roughly a third of the max profit you expected. And as you go up here, if it goes up to 26 or it goes up to 27, you're starting to get into that place where you're losing money again to the upside. You have sort of that upper and lower break even right around $27 or $28. So this is two ways to lose. That profit that you're trying to compare, the max profit on this first run, first right of this calendar diagonal spread, the peak return's about the same, but that only occurs at that price. Now, there's one other thing that we have to talk about here. Although this is showing us a potential return of 25.9%, if SLV is trading right at 25 on July 16th expiration, even if all of that comes to pass, there's no guarantee that you're going to make 25.9%. This is an estimation, the best we can do, and the same thing that your broker does or any profit and loss chart you look at options trading. What we have to do is use the theoretical pricing models to calculate what your 26 call would be worth on July expiration if the stock was trading at 25. Now that assumes, of course, as we're evaluating this position right now, that assumes that this volatility for the option of 0.3616 holds and it stays the same. So let's go to 25, short call strike price. Let's go to July expiration, 7/16. There's our expected profit of $82.61, $83 rounded up. Now, if over the course of the next 14 days, 15 days, 28 days to expiration, things in the market settle down a little bit more, volatilities on things such as gold, silver, SLV, GLD, things along those lines settle down, and this volatility drops to 0.30, close to where it is for the July series, you're only going to be at $7 of profit in this case, because the option isn't going to be as valued with a decline in the implied volatility. This return you're expecting is based on an assumption that implied volatility remains the same. Now, I'm not saying implied volatility is going to shift drastically. I'm not saying that's there. But when you're trading these diagonal calendar spreads, this is what you have to focus on. This is what you have to be aware of. You have to be prepared that even if your expectations are met in that one basic moment where you receive the maximum profit, analyzing on any profit and loss chart, not just ours, on your brokers, any broker you're looking at, it's making the assumption of what the option price would be worth, your long-term option would be worth if the stock was trading at the sold call strike price of your calendar spread on the sold expiration date. And you see how drastic it is. Let's go back. It was 3616. Nope, 3616. Okay. All right, so that was about the $83. Now I took it down 0.06, which was a fair jump. Let's just take half of that. Let's say it goes down to 0.333. So we would expect a $47 gain on the option if the stock's trading at $25 in that case. So up $1, delta of about 0.5, so gain of 47 cents makes perfect sense. But now volatility changes, you're only making 12 cents on that long option. Sure, we get the full 36 premium that we sold on that position in that case. But again, that's the effect that implied volatility will have. Okay, we can see that both ways too. Last little quick run here. I'm sorry, let's go back to the 23 strike, or 22 strike, excuse me. Let's add that back in. Okay, so we see the profit and loss chart here. Once again, we don't get into that loss level because it's an in-the-money long call. And it's at an implied volatility a little bit lower, 0.3432. So again, stock at 25 and 716. All right, so this would be an expected profit, as we saw, of $103, right? 102.67, 22.5%, 22.4%. Now, again, we take the big gap down. We're expecting a 67-cent gain by a $1.12 gain in the stock in the next 30 days, which makes sense. The delta is probably around 0.65 because it's in the money, not out of the money. Same exercise, though. We take the volatility down to 0.300. Rather than making $103, we make $56 on the position. Better than 7 that we saw with the out of the money option, if that had a drastic decline. And if we put it in the middle at 0.33, we're making 92 instead of the max expected 103. Okay, so because a lot of this is looked at on the intrinsic side of the position, at 25, it's going to be 3 points in the money, so it still have $2.51 of time premium as well. And of course, yes, if the short call expires worthless, Alice, this July 25 call, the stock stays at 24.50, and that expires. Yes, the plan would be you could continually to sell weekly or 2-week out calls against the position to lower down the cost basis long term. But again, with the structure you mentioned, in either case, remember, if the stock starts to run, you're going to have to manage this short call. You don't want to let it get assigned. Here's the trick. Everything I just showed you, the returns that you're seeing here is based on, again, the theoretical value of the long option at short-term expiration. Okay? Let's say the stock ran up, in this example, this is the 22 call, let's say the stock ran up to 27. What's you going to do? You're going to have to pay $2 to buy to close this call. To cancel the obligation, maybe roll it up to a 28 or 29 call further out in time. And the long option value here is at 697. But what happens if I'm in this 25 strike, 22 strike spread? We had our initial debit of, what was it, 459, right? Let me just take a look here. I'll leave that drawing there. Sorry. Yeah, 459 is the debit in this case. And here's our 25. And the stock moves up here to 27. We don't do anything about it. Think, okay, in just a few days, I'll go ahead and buy to close it, or I'll wait till expiration to buy to close that position. All right, so you have a debit of 459. Okay, now you know that you're off the max return here, but you're still at a slight positive return in this case. But if you get assigned early, what does that mean? It means you still have an obligation to deliver shares of stock that you do not own at that strike price. What is your broker likely going to do? They're going to exercise the long for $22 to deliver the short obligation at 25. You only get, if you allow assignment and allow the broker to exercise the long call, you only get the difference in strike prices back, $3. You're still at a loss of $1.59. Where's that $38 profit or the $103 profit you were expecting? That's only based if you're able to sell to close the long call and buy to close the short call. If you allow it to be exercised in the improper structure where the net debit of the spread, 459, is greater than the difference in strike prices, if you get assigned early, you could be locked into a loss even though you're expecting a profit on the position. That's the complexities of the calendar spread. This is what you have to pay attention to. The returns that you're seeing are based on either still holding the long option, having the short option expire worthless if the stock's trading above it, and the theoretical expected value of the long option. In the case where the stock moves up and we're still expecting a return here of, let's go up to 20, I'm sorry, let's go up to 26 if we can here. Yeah, there we go, 26. I'm still expecting a profit of $74 on July 16th. I'm looking at a loss if I allow it to be assigned because I only got $3 back, the difference in strike price, because my broker had to exercise the long call with still 560 days to expiration to cover the obligation I have of 100 shares of stock at the $25 strike price with the stock trading at 26. So they have to cover it that fashion. You are covered, but they have to do that. But now I only get $3 back. My debit in was $4.59. I'm actually at a loss because I structured it improperly. In that previous discussion I mentioned about the calendar spreads, we discussed here the importance of identifying positions of this fashion. We're buying an in-the-money call and selling an at or out of the money call closer in this case, that you always want the net debit to be less than the difference in strike prices so you don't get caught with that worry. Now, if you're watching it carefully and the stock starts to go to 25.10, 25.20, yeah, you're probably buying back this 25 call and rolling out to an August 26 or an August 27 in that case, okay? That's what you'd have to do, just like a covered call situation. But again, if you run the risk of early assignment, if it let it go too far above, you've got to know where your structure is. You've got to know where your net debit is because you don't want to risk losing. What are you losing? Why are you only getting $3 instead of $600 back? Well, at 27, this is $5 in the money, right? So with an expected value of $6.97, that's saying for the remaining 560 days, we've got $1.97 of time value still remaining in the position. The only way I can take advantage of that is by holding this call or selling to close it. If I allow it to be exercised, all we get is the intrinsic difference between the two strikes. We miss that time value, and that's why our profit is diminishing. And if we let it be assigned in this example, you'd see how it would be a loss because it wasn't structured properly as well. Okay, so that's what we talk about when looking at probability. Now, once you create a spread of this structure, what you are looking at, and what you will look at, of course, now in this case, is the probability of the July 25. Why? Because we probably don't want it to be assigned. We want it to expire. You want to keep all the premium. So there's a 28% probability that in the next 28 days, SLV will be trading above $25 per share. That's what you kind of want to see because you're hoping it expires worthless. And you'll keep that entire 34, 36 cents of premium that you took in. That's when you look at the probability, not the probability of the long call being successful. Last but not least, I'm not going to say that either one, I'm not saying the 22 strike is right either, okay? That's something you'd have to analyze yourself based on what your goals are for the position. I would look for a calendar spread that matches the criteria that I want, where that debit to strike difference ratio is, is less than 1, meaning my net debit is less than my difference in strikes. I'd probably want an IV over HV ratio of greater than 1 as well. But you're looking at this long call in this calendar spread because you have an anticipation of SLV. And a great tool to sort of analyze what call might be the best to buy, whether it's long-term or whether it's short-term, is the long option finder. Here we just put in our symbol, and we put in the expected price of the stock, let's say $26. And, okay, so I'll put in $1,500 into the position, let's say. And the expected date is that, I know this is far out, but I'm going to expect to say that sometime by October, I think that's going to recover, let's just say October 13th. Right? Now, this didn't go far out for us, but what it's showing us is which long call would give us the best theoretical return based on today's market prices, how many contracts I could buy based on the investment amount that I put in, and based on what the expected value of this call would be if the stock was trading at $26 on October 13th. Okay? This is more for straight call buying, but it does give you a gauge of what to expect. Why aren't we seeing those further out options in there? Because they had to pay into so much time value for the January 2023 and 24s that at this point, the stock's trading at $26 on 10/13. Those options would have a positive return, Alice, but they're only going to be 14%, 13% on the long option. This is sorting it by highest return to lowest in this case. Okay, so that's just a useful tool to use when you're trying to gauge what call might be the best to buy based on your expectations close in or far out in time.